Good afternoon and welcome to NYFP. In midday trade on this Friday afternoon, the major U.S. stock averages continue to trade in negative territory. Joining me now is Stephen Guilfoyle of Meridian Equity Partners. Hi Steve, thanks for joining me.
Always glad to be here, Remy.
Well, ahead of the weekend, we're seeing a pullback in U.S. stocks, but that does come on the heels of yesterday's strong rally, and that did come on the heels of the EU deal. What do you make of what we're seeing right now?
Well, you just saw some really mild profit taking today. The indexes really aren't coming in that far. Gold isn't really coming in that far. I think it's just some profit taking going on in both arenas.
Well, looking ahead to next week, we do have central bank monetary policy in the spotlight. We have the Fed rate decision as well as Bernanke speaking, and then we also have the ECB rate decision, and that will be the first time that Draghi will be chairing a meeting. What do you expect to see?
Well, I think that's really a big piece of why we're holding on to most of yesterday's gains. I think even though the GDP came in right where we expected yesterday, projections are not really that great for the fourth and first quarters. We're probably going to see next week some kind of, they're not going to change any rates next week, but I think the tone of what they say is going to be more tolerant of an inflationary future. So I do believe that they're going to set the stage where if they think they got to go with this QE3, 4, 5, and so on, that they're going to set it up so they can do this. And I think that's why all asset classes are trading dramatically higher. The Europe thing was great, and everybody's happy, except there's almost no detail, and none of the problems are truly solved. And we saw with the cost of Italian debt this morning that one day after a deal, that you would not think that their debt would cost them so much just to issue. So I do believe that it is probably more of a inflationary monetary easing state of mind which has these prices so high.
Well, Steve, it's interesting you brought up the GDP figures. They did come in line with estimates, and after the EU deal, the worst case scenario has been taken off the table for both sides of the Atlantic. But for the rest of this quarter, what does it mean for the equity market?
Well, I mean, you're going to see some amount, like I said, with the inflationary nature, plus there has to be some window dressing going into the end of the year. So you might see some volumes dwindle as we go into the end of the year, but you're probably not going to see prices come in all that much unless something really harshly negative happens.
Okay, Steve, last but not least, before we wrap it up, next week does bring the end of October as well as the beginning of November, and that means we'll be getting that good old jobs report at the end of the week. What do you expect to see for non-farm payrolls and the unemployment rate?
Well, I don't think the unemployment rate's going to come in. I think it'll stay 9.1 or even 9.2. I don't think the non-farm payrolls will come in below 400. They'll probably stay in the 410 arena. And there we are. If we get below 400, that could change the game. That'll be a much happier setting. And you might see a drop to hopefully 9.0, but I don't think it's in the cards.
Okay, Steve, well, thank you so much for weighing in on all these topics, and have a great weekend.
Oh, same to you.